$25 billion. In 1988, that was the price of the largest company ever taken private, the biggest deal in the history of Wall Street. But the people who bought it put up almost none of their own money. Out of $25 billion, barely $1.5 billion was theirs, less than a nickel on the dollar. And within 2 years, winning it would nearly destroy them. This is the Rubicon Brief, inside the biggest deals in business, the structure, the strategy, the decisive moments. Today, the most famous buyout in history and the one that almost destroyed its winner. RJR Nabisco is remembered as the deal that defined an era of greed. The cigarettes and cookies giant fought over by Wall Street's biggest names. That's the story the movie and book told. But underneath the drama is something more important. This wasn't private equity's greatest triumph. It was the moment the whole model nearly broke, when ambition wrote a check the business couldn't cash. This is how the most famous buyout in history almost became its most catastrophic. To understand the war, understand the prize. RJR Nabisco was born in 1985, a merger of the tobacco giant R.J. Reynolds and the food company Nabisco. A corporate odd couple, Winston and Camel cigarettes on one side, Oreos and Ritz crackers on the other. It threw off enormous amounts of cash, but Wall Street didn't love it. Tobacco lawsuits hung over the share price, and the stock sat unloved at around $56 a share, and that made it the perfect target for a leveraged buyout. A leveraged buyout, an LBO, is when you buy a company mostly with borrowed money, using its own assets and cash flow as collateral. Put up a little of your own cash, borrow the rest against the target itself, and a small sliver of equity can control an enormous business. RJR was ideal. Steady cash flow, low debt, fixable problems. One Wall Street estimate pegged its breakup value at $85 to $92 a share, far above where the stock traded. Someone was going to notice. That someone was the man already running it. Ross Johnson was RJR's chief executive, a charismatic Canadian with a taste for the high life, corporate jets, country club memberships, the excess of 1980s corporate America made flesh. In October 1988, Johnson made his move, offering to take the company private himself in a management buyout at $75 a share, about $17 billion. And it was the worst decision he ever made. By bidding low for a company he ran, Johnson didn't quietly seize it, he put it in play, telling the world that RJR was for sale and that its own CEO thought it worth far more than the market did. The board refused to simply hand it over. It had a fiduciary duty to its shareholders, so it formed a 5-person special committee chaired by the outside director Charles Hugel and did the one thing Johnson hadn't planned for. It invited other bids and ran an auction. And then the leak started. When directors learned that Johnson and 7 colleagues stood to take as much as $2.6 billion out of the deal, the mood turned. This was no longer a buyout. It was a feeding frenzy, and the man who lit the match was about to lose control of the fire. Enter Kohlberg Kravis Roberts, KKR, the firm that had practically invented the leverage buyout. Henry Kravis and his cousin George Roberts were the most feared deal makers on Wall Street. KKR bid $90 a share on the 24th of October and played a ruthless opening move. It hired nearly every major investment bank in town: Drexel, Merrill Lynch, Morgan Stanley, Wasserstein Perella. The logic was brutal. Hire them all, and your rivals have no one left to advise them. For one strange day in early November, KKR and Johnson's group even agreed to join forces. The alliance collapsed within 24 hours, poisoned by mistrust, and Johnson fired back on the 3rd with $92 a share. The board stepped in to impose order. It set rules, sealed bids, no carving up the company in advance, and a deadline, 5 p.m., the 18th of November. When the first round closed, Johnson's group bid $100 a share. KKR came in lower at 94, soft enough to look like it was losing its nerve. Then, a ferocious shot from left field. The investment bank First Boston lobbed in a proposal worth as much as $118 a share. Not fully financed, but credible enough that the board extended the contest to a second round, closing the 29th. It was then that KKR did something curious. It appeared to be backing away. Kravis left for a skiing weekend in Vail. Roberts flew home to San Francisco. The signal to rivals, "We're out," but both men stayed wide to their New York team. When the second round bids were opened, KKR hadn't retreated at all. Its offer had jumped to 106. Johnson's group, reassured by the retreat it thought it had seen, had nudged up only to 101. First Boston, unable to finance its bid, collapsed out of the race. The bids were in, but they weren't the end, because the board didn't simply pick a number. Its special committee, advised by the bankers Lazard Frères and Dillon Reid, now negotiated directly with both camps for their best and final terms. That was Wednesday, the 30th of November, and the negotiations ran some 30 sleepless hours. When Johnson learned the committee was leaning towards KKR, his advisors fired off a furious letter, astounded the directors would go off into the middle of the night to negotiate. By the early hours of the 1st of December, Johnson was back in the fight. That morning, the committee gave him 15 minutes to improve his offer. Chain smoking, he submitted 112. Then the committee turned to Kravis for a final number. He delivered it with a warning. If we don't have an answer in 30 minutes, we walk away. 34 minutes later, it was over. And here is the twist that defines the whole story. The board chose KKR's $109 over management's $112. The highest bidder lost. Why would a board take $700 million less? KKR promised to keep the company largely intact, selling perhaps $5 or $6 billion of assets. Johnson's group planned to sell the entire food business, around $13 billion worth. The board didn't want the company gutted. KKR also left more behind for existing shareholders, 25% of the future company against management's 15%, about $500 million more for the people who already owned RJR, and there was Johnson himself. The leaked windfall, the time cover, the sense that management was, in the words of one board source, still trying to steal the company. The losing side was bitter. "We were cheated," said one. A source close to the board put it more coldly. The board could not appear to favor management in a buyout. That night, Johnson went back to his office, poured a drink, and ate Oreos while the city glittered below. He'd lost, but the irony was just beginning. KKR had won partly by promising to treat the company gently, sell less, protect more, and had just paid a price that made keeping that promise almost impossible. Here is the number that matters most. Of the roughly $31 billion of total capital behind the deal, only about $1.5 billion, under 5%, was real equity. The rest was debt. 95% of the biggest deal in history was other people's money. To raise that mountain of debt, KKR leaned on junk bonds, high-risk, high-interest bonds of the kind Drexel Burnham Lambert had built a market around. Some of it was riskier still, debt that paid its interest not in cash, but in more debt. And then there were the reset bonds. Think of a reset bond like an adjustable rate loan with a cruel twist. If the company starts to look shaky, the interest rate doesn't drift, it ratchets up automatically to prop the bond back to face value. The weaker you get, the more the loan demands. It kicks hardest exactly when you can least afford it. Every month, millions of dollars left the company just to pay interest, not to build factories, not to launch products, not to hire people, just to service debt. For a while, it held. Then, in 1990, everything turned at once. The junk bond market froze after Drexel collapsed and his king, Michael Milken, fell. A cigarette price war hammered tobacco profits, and RJR's reset bonds came due at a level that would have pushed the interest rate above 20%. The company was staring at default. To stop it, KKR had to do the thing no buyout firm ever wants to do: pour fresh cash into a deal meant to pay them, around $1.7 billion, to buy back the most dangerous bonds before that rate could trigger. How close was the edge? A sister KKR company, financed the same way, filed for bankruptcy that same season, days before its own reset would have hit. RJR very nearly followed. So, after the war, the record price, the near collapse, who actually won? The original shareholders did. The board had protected their interest immaculately. They'd sold at $109, double where the stock started, and walked away clean. The losers were the bondholders who already held RJR debt before the buyout. They were done real dirty. The mountain of new debt shredded the value of the bonds they held, and they sued, reshaping the rules of corporate debt and creating protections that still exist today. The bankers and advisors, they were the surest winners of all. More than $700 million in fees changed hands, paid whether the deal soared or sank. And KKR, the firm that won the war, by most accounts it made 1 or 2% a year on RJR, a feeble return for a firm that usually delivered 20 or more. It spent years untangling itself, finally swapping its stake away in 1995. Barely whole. The boldest buyout ever attempted bought a company with almost none of its own money, and the prize nearly took the winner down with it. $25 billion, the largest company ever taken private, bought for less than a nickel on the dollar of their own money, and within 2 years, winning it nearly destroyed them. That was the moment private equity discovered the limits of its own ambition. This was the Rubicon Brief. If you want more of the biggest deals in business taken apart like this one, subscribe and leave a like to help others find it. Until next time.